one of the greatest advantages in venture capital is tenure and staying power. And the reason it is one of the greatest advantages is because most people don't have it, right? And it feels like it if you're new in the industry or you've only been around a couple of years, it feels like everybody sort of stays. But you hang around long enough, you realize how many funds turn over, how many people within funds turn over. And so much of the advantage that comes in venture capital is reputation. And so much reputation is time. It's like, was that person a good human? Who are they associated with? Who backs them, right? What resources do they have? Like, how did they act in tough times? Did they soldier through like macroeconomic swings and so on? And so our greatest advantage will be sticking to something that's just so obviously going to continue to work, right? And it's obvious because entrepreneurs are just on the rise.
Hello and welcome to another episode of Ways to Wealth. Today, I'm lucky enough to be joined by Robbie, one of the pioneers of the venture capital and investing space in New Zealand. Robbie, why don't you give us the TLDR on who you are and how you got here?
I wouldn't label myself as a pioneer, but I'm a fortunate sort of benefactor of the rise of entrepreneurship and investment in New Zealand. I run Icehouse Ventures, a venture capital fund. We've invested $530 million to date across 350 early stage companies in New Zealand, and very simple mission: get out, find, invest in, and add value to the most promising Kiwi entrepreneurs.
Nice. Awesome. So there's an accent, and I don't know much about your background, even though we've known each other for a while. So like today for me is a bit of an opportunity about I know the vision of Icehouse Ventures now, and I know how it's evolved and where it's at today, which I'm quite excited to talk about. But when did the bug start for this whole entrepreneurship and investing space?
Yeah, there is an accent from North Carolina.
Okay.
So now I'm sort of 50-50. I don't know. About half my life I've spent here.
Right.
Moved here in 2008. Had told people in the U.S. When I was moving here that I had a job at Icehouse that I didn't actually have. But I had one connection to Andy, the CEO. And to be honest, it was probably a pretty tenuous connection. And then who am I? Sort of like just some random American showing up. Will I stay? Do I have any value to add? Do I have any relationships? All of those were very fair questions to ask. So the only way I could sort of get my foot in the door was to insist and to work for free. And so in about December 2008, I started working for free. Icehouse was a incubator and an angel network at the time. No, not a venture fund.
Right.
And I stayed around, and here I am, coming up 17 years.
Why did you choose to pack up and come here?
I'd studied in New Zealand in 2007.
Okay.
Fell in love with the country. I traveled here in 2004, and I traveled here in 2001. And so I just was successive sort of relationship building. And I can't say I sort of forecast that it would become the utopia that it has become, I think, or that I would have had opportunities that I've had, right?
Yeah.
But there was something that drew me here, and that has kept me here. And I think it's just that the quote that I think about New Zealand is one that is famous for the Grand Canyon, which is there are canyons that are deeper and there's canyons that are wider, but there are none that are grander.
Okay.
And I think that sort of speaks to New Zealand, right? Like, if you want big cities, you're not going to find them here. If you want history, you're not going to find it in the same way that you could find it in Europe. If you want the most profound natural beauty, you'd probably find it at Everest or whatever. You won't find the most culture, but it sort of has everything, and has a very high ratio of everything to people, which makes it that much more accessible. And then you just have a great politically stable, English speaking country sitting at the bottom of the world that I think is very favorably positioned for the future. So yeah, I'm more convicted by the day.
Oh, that's cool. Similarly, I fell in love with the country coming here to study for a year.
Yeah.
As well, when I was 16, 16, I don't know, fifth form. And yeah, it's funny, isn't it? I mean, do you go to the States quite a bit, but when you go home, do you feel like it's weird where it's familiar but not home, and here's home? Do you have that same?
There's a quote that's when you leave somewhere, everybody are triangles, and you get to a new place and everybody's square, and then you go back home and you're a circle, and you sort of don't fit in anywhere. I mean, and don't get me wrong, I'm America's #1 fan. I think it's great. There's some people that move here because they don't have deep roots or emotional tie
Yeah.
to all the great things about America. And that's not me. Like
Yeah.
I love spending time there.
Okay.
If you had to sort of stack rank all the features, I think New Zealand wins and, with all things considered. But the beauty is like, it's not that hard to get there.
Yeah.
It's not free, but it's one flight overnight, have an extra coffee, and you're going,
To go.
and I think that's like a complete misconception. And remarkably, I mean, planes haven't even gotten faster. They've definitely gotten a little bit more livable.
Yeah.
But the West Coast is right there,
I know.
right? And
And a time zone perspective as well, it's there. From a time zone perspective, like if you're actually serving American customers, it's super feasible.
Yeah, I mean, it's much more pronounced, the change coming from your side of the world, right? And literally being on the opposite side of the world, that's hard. But
Yeah,
America's right there.
yeah, it's a thing. Well, I kind of find that like maybe India and Asia actually are more kind of perplexing time zone to get used to, because like at least with the UK and Europe, you're like, oh well, it's just the opposite.
Yeah,
Whereas like India and like Singapore and stuff, you're like kind of like, oh, what's the time? You have to do a little bit more mental math on where we're at.
don't try to do business in Nepal. They put themselves 15 minutes ahead of India, so they weren't the same, and that's an impossible calc. I can't.
Yeah, that's right. You'd never be able to do that. Google can probably sort it out.
Yeah, but the amount of GDP and opportunities they probably lost just out of missed meetings between Nepal and the world, I wouldn't want to know.
That's hilarious.
Yeah.
Wow. So that's actually a kind of an interesting start. So you come here, you go, well, I need to generate value. I'm going to work for free. That's like the ultimate hustler story. How long did that last, and what did you kind of know what value you were going to bring? Like you had an idea of, okay, I'm coming into this thing, I need to prove myself. Did you have any kind of, I'm going to do this, this, and this, or it was just like, I'm just going to wing it?
Well, I mean, when you graduate from university, like unless you graduate with a very special degree, and you're working in a very special, specific industry,
Yeah.
you probably don't have that much value to add. So all you have is your intellect and your work ethic, and and a positive attitude, and the willingness to say yes, and and I'm so grateful for that moment. Like, there's just so few moments in life where you really push yourself to a point where you have to make something work.
Yeah.
Right. And those are the best moments, right? That's the most formative, and that's what shapes you on some path that I think can craft like a really bright future. So yeah, I I had enough confidence to think that I could just do something.
Yeah.
But that's about the extent of it. And I knew that I was free as a fly, and I could just work as hard as I possibly could. And so that's what I did. And I worked till about the end of February. And at that point, I was actually contributing to a pretty important project, and that had like revenue implications. And I certainly think, young people like don't get too intoxicated with the whole idea. Like, it's not about the money, because ultimately you do need to be paying for yourself.
Yeah.
Right. And that's what makes it an easy decision for an employer.
Totally.
And so then they started paying me $20 an hour. And I stayed on that for almost 2 years, and then worked my way up from there. But that, initially, I was there to help in any way possible. And that was sort of my pitch, because they actually, I arrived late October, and they said in sort of November, like, hey, sorry, there's no roles. And keep in mind, it's 2008. There's not really, the hiring's not happening.
No.
Right. And I was like, well, surely you need a warm body for something. So whatever, I'll just clean, I'll show up and try to find a way to help.
So yeah, nice.
Yeah.
So you kind of, how long do you think you took to like figure out the lay of the land and like kind of find your spot? Because like obviously now you're running the show.
A long time. Yeah. I think there's a lot to learn, and there's certainly some faster learners in the world than me. And I think you're not just learning sort of like functional stuff related to the business. You're learning how to interact with people and collaborate and be a good team member. And that took a while, right? I was fortunate in a professional sense to have you know, initially hosted a U.S. angel who came down for 6 months, a guy named Bill Payne,
Okay.
and so professionally that was eye-opening. Essentially my job was to do everything to host him, like book his wife and tennis lessons and get them an apartment and arrange travel. But it also meant that I sat in every single presentation with everybody for the better part of 6 months.
Yeah.
And that certainly opened my eyes to the investing world, and it got me more entrenched in it.
Yeah, I think people that are looking to become a founder, they should go get a chief of staff role.
Mm. Yeah,
Like,
that's interesting.
just go and get
Yeah.
into it.
Yeah.
And get that varied experience, because that's going to be like the closest thing you can get other than starting your own thing.
Yeah,
But it gets that mentorship as well and that wisdom side of things that,
that's right.
I think is super valuable, potentially underrated. Because I do think it is like, that brute force approach to just be really relentless and learn and like make mistakes and just keep getting up. It works.
Yeah.
But actually, I do think that if you can kind of garner some wisdom, like you'll just get less scars.
Yeah, that's right.
Um,
And you see all the different facets of the business. So
yeah. And I think that role is becoming quite popular. And like you say, you get that full picture. And that can be really helpful because otherwise, you might end up going in just with a speciality and that's where you feel safe.
Yeah.
Whereas if you get thrown in the deep end, that's a great thing.
yeah, the more you can say yes, the better, right?
Right.
And certainly my guidance for new starters, it's like say yes to everything, right? And including every event in the evening, right? I don't think you appreciate at the time how liberating it is to just be working your way up, and you probably don't have kids, you probably don't have
Yeah.
relationship or mortgage, you've got your friends and you can hang out with them. But you have a lot more clear air, and there's a compounding advantage to applying that early in your career to build capability and credibility, and
Well,
you leverage that moving forward.
yeah. And the compounding effect of relationships,
Yeah.
and if you can start those networking events, I mean, you look at Jack. It's kind of a prime example of someone that's compounded relationships over like a really long period of time, but is super young.
Yeah, nothing more powerful than just being a consistently, kind, real human,
Yeah.
right? I mean, relationship building and so on, it really is the tortoise, not the hare, right? You can't rush into these things, and trust is built over time. And I think people learn that, folks come and go, and so then if you know that people come and go, then you're not inclined to just sort of jump headfirst into a relationship. You want to suss them out and see if they have any staying power in your industry.
Yeah, for sure. Nice. So the industry has changed dramatically since 2008. Like at what point, but I would say that private investment is very popular relative to other investments regionally. Like I would say that kind of it feels like there's like property and private investments very high on the totem pole in New Zealand, and then there's everything else. So I guess there's a kind of an unfair advantage in that private investments have been very appealing to Kiwis, which has helped the venture scene, I would say. Um, but was there a like inflection point when you were like the growth rate has just changed?
Yeah, I think you got to really reflect on the history of New Zealand and why in 2008 it was such a ghost town when it came to sort of equity investments and venture, by extension. And it's this: for most of the time, Kiwis were hardworking, living off the land, building value off the land, and buying property, and that was working pretty well. And then coming in the 80s, everybody had like built a little bit of a savings or wealth or whatever, and started investing in the stock market. And then 1987 happened and wiped out, and that was extremely scarring. I know that because I showed up like 20 years later and people still talk
About it, yeah.
Right.
And they still talk about it today.
Yeah, and so I think the vast majority of people sort of regressed, and then they were like, well, let's just go back to what we know, property, and then that worked ridiculously well.
Yeah.
And meanwhile, by contrast to Australia, there was no KiwiSaver, there was no entry point to equities.
Yeah.
And the really powerful thing about KiwiSaver is people sort of do it in their sleep, and then they, wake up one day and they have enough money in there to care about it.
Yeah.
And then they take an interest, and then that interest leads to further exploration and investment, and that goes from a passive long-term savings fund to all the other permutations. And so the growth that's happening today is thanks to 2007, really, I think, where KiwiSaver came in.
Right.
And opened people's aperture a little bit and said, hey, property's not the only way.
Yeah.
Right. In fact, probably be careful, being all in with that.
Yeah, I mean, we do this financial well-being program with employers mainly, but also individuals that are part of our membership. And the amount of like high earning, like if you just looked at their earning line, you'd be like, wow, they've got it great. And then you dig deeper and you go, wow, cash flow is a real issue. And it is it's often at the moment that concentration in property. You have that's just like wrecking the cash flow. But also, like you say, as an asset, if you look at the breakdown of assets, it's like 95% property.
Yeah.
I mean, this
And it frustratingly, it worked.
and you were being concentrated. I actually don't have a problem being concentrated. Like, I think, if you look at people that have made real money, like they often were real concentrated, right?
Yeah. Yeah. And I mean, definitely in venture with our fundraising, right? So we've now 2,100 individual investors in our funds. It's high net worths, family offices, institutions, you name it. And then another 1,000 investors who've invested with us into individual companies. And my conclusion now is if you meet somebody and, their bread and butter is something different, and there's any inkling that you're going to have to change their mind, don't go there, right?
Don't talk to them.
Don't bother, right? It's like, hey, actually stick to what you're good at, right? Just stick, you're comfortable with whatever, commercial real estate, stick to that. I don't want to spend my time trying to convince you that this is better or equal, right? All of the investors that come in have some built-in predisposition to say, no, actually, I like being part of aspirational technology companies. And I do think about having, small amounts of my wealth invested in, interesting aspirational entrepreneurs in New Zealand. And I like the idea of, new technologies that can help the world. And those are the ones that invest, right?
Yeah. I think that's maybe we should like double click there a little bit, because I think that's also something that founders can learn, in terms of like we're in this accelerator creative HQ, and we were talking about it. We're having a bit of a round table about, I guess the fundraising journey, and some of us are on different stages, and I've been fortunate enough to obviously raise some money a couple of times now.
Yeah.
And I'm like, just stop talking to the wrong people and get a definitive no straight away, because that is way better than 5 meetings of trying to persuade them into an asset class or into the project if they don't get it.
Yeah.
And same goes to like kind of a lot of like they were having meetings with investors that ultimately were never going to touch them.
Yeah.
Because wrong stage, wrong timing. So we should, as founders, be focused on like, where we can get that return on our time, because time's all we got at the start.
Yeah. It's very difficult because two things can be true at the same time. One is it's obvious within 60 seconds if somebody's interested. The second is that people often have to say no a few times before they say yes. So it's like, well, okay, well then on that basis, where do I apply my time?
Well, that's a good point.
And, tenacity in fundraising, which is a form of sales, is really important. And I've certainly been on roller coasters of that over the years.
Yeah.
But you're right. I've probably said this quote more than he has at this point. But full credit to Nikki at Blackbird, where he said, in fundraising, you're not changing minds, you're just surfacing the believers.
Right.
And you do get that feeling, right, where where you meet one person and it's an uphill battle, and you meet the next person and they can complete your sentences for you, or they can grow your aspiration, and then you're like, I'm onto something,
Yeah.
And so then if you get to those people, it's like, well, I need to do a calculus on their context, and like, do they have time, emotional capital or real capital to invest?
Yeah.
do they buy into my terms and everything else?
Yeah. Qualifying and that expectation. I think having low expectations is always great, but then just mixing that with, okay, I'm talking to this person, but I don't need capital from them because I'm maybe building relationships and I'm building that compounding effect of letting people know this is what we're doing and this is what we're trying to do. And then
Yeah.
kind of being like, okay, and kind of putting them in buckets. And I think you should, as you know, internally when you're raising capital, it should be like fully like a sales cycle. Like, what would this be like if this was you selling your widgets?
Yeah.
Because it is that.
Yeah, it is. Yeah, like investors, and you are in fundraising, you're selling something that is more of a vitamin than it is like a medication, right?
Yeah.
Because they don't. What is the alternative to buying shares in your company?
There's a
Keeping your money, and putting it in something else, and then you could say, oh well, you're going to miss out, on the greatest thing, and investors have to say, well, it's possible, right?
Yeah.
But we'll find out like in a decade, and
then it'll be later.
I'm sort of busy, so like I just I'm willing to take that gamble right now, right? Because there's not a complete certainty. So you're not, yeah. And so keeping that in mind, you really do have to find a way to create urgency and sort of emotional buy-in where they're like, no, actually, I want to back Charlie. Like, I have to, I'm going to do it.
Totally. Yeah, that's a really good point. And I think, and this kind of is moving on out of founder land, but I think to give context to founders which is helpful, is like, you're running a business, as in, okay, if you go to individuals, it's different, right? There's probably not their business. It's probably like, okay, like you say, they have an inkling towards seeing founders succeed and seeing change in the world often.
Yeah.
That there's obviously a kind of clear kind of sense of early adoptership with angel investors, but then venture is a business, and you guys are running a business, and it's not an easy business, and you've got to do your sales cycle so that you can feed your business, which is deals. Like, what are the biggest challenges when it comes to you guys running your business? Because you're doing two jobs at once.
Yeah, we very much are a business. We're actually a venture-backed business, right?
I'd love to talk about that too.
But I'll say that, and I'll also say though, like I am not trying to put myself on the same playing field as entrepreneurs, because I have a deep respect for genuinely building something from the ground up, and all the sort of pronounced challenges that come with that. So I'm not calling myself an entrepreneur in that respect. That said, we've taken in 15 million in primary capital. We've done 7 million in secondary capital. So like we have shareholders that have traded their money for ownership in our business.
Yeah.
And about 100 of them too. So there's institutional investors in there, and there's individuals, and there's friends, and and then from a fundraising point of view, literally no entrepreneur, unless I guess you've run like a publicly listed company, has done more fundraising than me.
Yeah.
Because we're fundraising for our funds all the time, and raise $500 million with an average check size like in like the 250 grand range is a large number. Obviously there's
it's wild
80 million in institutional investors, but that we're always on fundraising and always getting told no and always being second guessed, and so it's definitely part of the journey. But I like venture fundamentally is so defined by the sort of power law, and it's defined by these sort of feedback cycles where you are either an attractive source of capital, and thus you get your foot in the door with like an incredible company, and thus you benefit from the halo effect, and then you, as a result of that, can raise more money, and as a result of both of those things, you can attract the next company, and on it goes. Or you're going the opposite direction and you're dying. And so that's sort of each day I'm waking up, I'm like, is this a very slow, painful death, or are we moving in the right direction towards the promised land?
And I guess it's quite hard to know.
Yeah.
Like on a day-to-day incremental basis, you're like, feels like we're going in that direction, the right direction, but we are going to find out about our decisions today, obviously, minimum for most of them 3 years later.
You cannot measure the success of a business in venture capital on exits. And here's why: because they're the most backwards looking metric you could ever have, right?
Yeah.
So 2017 Powerball proxy sales to Apple, was it reflective of anything we were doing in 2017, 16, 15?
Right.
No. We could have been acting horribly. We could have been losing market share. Like, we could have been losing the competitive advantages and having high turnover in the team. And then we'd be like, oh, look at that cash return, right? So obviously we're doing the right thing. It's like, no, you're not, right? So I think there's many more granular ways to look at on a daily basis, are the actions you're taking contributing to the long-term mission of, attracting and investing in great companies? And then, returns are an output of that, right? And a force multiplier. Like, you have a big cash return, you get both the benefit of making investors happy, at which point they'll probably recycle capital, and having that sort of credibility that comes with being associated with winners. And then you can talk to new companies, and if you can talk to new companies, then
It's reflective,
on and on it goes.
right?
Yeah.
It's positively reflective or negatively reflective as well. If you get a few kind of bumps,
Yeah.
which become consuming, and that might not be necessarily to do with the decisions you're making now or even the past.
Yeah. And I think the thing about venture capital is you also have to be very careful measuring it in revenue in the near term, because often sources of revenue can be at odds with doing the most important thing, which is attracting and supporting great companies. And I always sat there, in the early days when we really were trying to make ends meet, right? And it's like, well, I hope we can, earn ourselves a salary.
Yeah.
And I looked with admiration to some of the sort of like veteran super angels who didn't have to think about where their next meal was coming from.
Yep.
So then they could think about the founders.
Yeah.
And gosh, obviously that's helpful, right? Or just think about thoughts that are helpful for founders, or perspectives on the world that make you a better investor. And if you were trying to chase a sponsor, or like make money from some consulting gig, just totally fair. If you're trying to earn money, we can often be doing that at the detriment to your mission.
Yeah.
And so certain, like, it wasn't part of the pitch when we brought in all this equity capital, but it was certainly in the back of my mind that the more that me and the team can just be focused on the long-term value creation, which is equity ownership in great companies, and helping great companies become great, the better, and drop everything else. Right.
Have you guys managed to structure it how does it work? Like, do you just, as a part of the capital you've raised, you just you're in the LP as well? Like, how's it, or how do you get a stake? I know you get carry and management fees, and the carry is obviously great, but like you kind of talking in really long-term kind of views. So how is it working with you guys? Are you getting a stake in every single entity?
Yeah.
Is that through direct investment, through tipping capital in, or are you able to do you get some sort of equity from the structure of the fund, or how it works?
Yeah. So most venture funds essentially charge the investor a management fee, and that keeps the lights on. And certainly the pitch to our shareholders is like, I'm not going to create a ton of value for you, although it is possible, on the business of management fees less cost equals profit, right? The real value is the second part of an arrangement with a venture fund, which is called carry, which is a profit share on funds invested.
Yeah.
And that is a potential runaway, right? Like, if you deliver outsized profits to investors, you can retain 20% of it, and everybody's happy. And so to answer your question, we have that, we have management fees, and we have a balance sheet of investments where we've been putting our own money, or in the company balance sheet and our own money, into individual companies. That's interesting. And it is compounding, because we also have this policy where any return, any carry payout, we just plow it back in. So, a couple million came in last year from various things. That is our allowance for our future funds, right? But we don't do direct investments. We just put, so we're on the same terms as our investors. We just put it back into our funds. So if you have $1 million and you're raising as we will this year, our fourth seed fund. We'll put $1 million into seed fund, and then that'll be in 30 companies. So you have, 100 or so into various companies. And, but at a certain point, carry is just so much more valuable, right? The profit on $100 million fund versus the multiple on $1 million cash investment is very difficult to compete.
Yeah, for sure. Oh, that's interesting.
Put in a simple way, if you 10x the fund, that's $900 million profit, and 20% of it is $18 million. If you 10x $1 million, that's $10 million.
Yeah, it's
So,
amazing.
yeah.
That's cool. But you kind of talk about it from a balance sheet perspective, which I liked. Like our last conversation stuck with me when you were talking about the actual balance sheet of Icehouse Ventures and what that can be over the long term. And that's definitely not something I've really heard directly from other funds and venture funds. What was the idea behind that? How did that kind of? It feels like that's a slight culture shift from from 2017 when I was like aware of you guys. It seems like a slight evolution or major evolution.
Well, I mean, the more convicted you get in entrepreneurs and startups, the more you want to be in, right? And so the idea is, that we create as much leverage as we can to get as much upside in the future by association and ownership in great companies. And at any point when there's a return created, we reinvest that return and just keep growing it for hopefully ever, right? And and I mean, I, I I think you can apply, some credit to the cultural shift of our mission, right? Um, and some of that credit is due to becoming a more robust business ourselves, right? I actually in 2017 I did a color coding bar graph of the different revenue sources, and I colored them from red, bad, to green, good, meaning the red is the type of revenue that is the least aligned to long-term value creation by backing great companies, right? And green being the most aligned. Now, the darkest green would literally just be cash returns, right? The next is like carry, right? In the middle, and I'd say on the green side is management fees, because it's a known recurring source of revenue that is completely normal in the venture capital industry and doesn't come at any expense to the founders. Right. On the far end would be selling services to founders or trying to monetize the short-term relationships or brokerage. Right. And that can literally come at a cost to your long-term value. So I color coded all of it, and I said, we're going to take it in a single direction, which is all green. And that's what it is. And it's also 5 times larger than what it was, which surely speaks to the benefit, right, of focusing on like the real long-term value.
That's totally true. So with that in mind, then, like, I mean, 5 years is too short for you in a way, but like 5 years from now, like, what would be the same and what would be different about Icehouse Ventures?
The same is that our mission and our focus on very early stage to late stage high growth New Zealand entrepreneurs, like that, it's not going anywhere. All right. And I know that with such conviction because one of the greatest advantages in venture capital is tenure and staying power. And the reason it is one of the greatest advantages is because most people don't have it. Right. And it feels like it if you're new in the industry or you've only been around a couple of years, it feels like, everybody sort of stays. But you hang around long enough, you realize how many funds turn over, how many people within funds turn over. And so much of the advantage that comes in venture capital is reputation. And so much reputation is time, right? It's like, was that person a good human? Who are they associated with? Who backs them, right? What resources do they have? Like, how did they act in tough times? Did they soldier through like macroeconomic swings and so on? And so our greatest advantage will be sticking to something that's just so obviously going to continue to work, right? And it's obvious because entrepreneurs are just on the rise, and you can't bet against them. So that's the same. I think that the state of the ecosystem in 5 years will be as unrecognizable as today is relative to 5 or 10 years ago,
Yeah.
right? And I think there's a lot of reasons. One is recycling of talent, right? And I don't just mean an entrepreneur sells a company and starts a new company. I mean somebody's part of a growth story,
Yeah.
then they jump to another one and they take their experience having built or worked within a company
Yeah.
that's a startup and joining another startup, and you can see the generations happening now that weren't in existence, right? It was all first time. And like 15 years ago, you'd raise money and I don't know, you hire software engineers from like telecom,
Right.
or Microsoft New Zealand or something. I mean, now you're like, in a positive sense for the ecosystem, you're poaching them from each other, right?
Yeah. That's right. And they've been through the ringer a few times.
Yeah.
Done it.
Yeah. I mean, the amazing thing is now you can start to see certain companies say, no, actually, I don't hire from the other company, not just for a relationship thing. I've heard that too, but because it's like they're distinct as a startup in their style, right?
Yeah.
And there's, multiple companies that I respect deeply that are pretty much like, I would never hire anybody from that company because they're just not our vibe.
Yeah.
Right.
Yep.
And that speaks to the maturity of the ecosystem, and speaks to the foundations that have been laid for new companies to start and evolve and learn from everybody that's sort of been trailblazing, right? The second thing that New Zealand has is like, we didn't have to do anything. There's a global shift where when I left the US, the narrative was I invest in my backyard, right? It was like, I invest in my area code or my city or whatever,
Yeah.
right? That's changed. New Zealand didn't do anything to change that. It just changed, and everybody, for the most part, invests at least across their country and more and more so across the world.
Totally.
And so that means more capital that was previously not available to New Zealand is readily available.
Something like Tiny as well, like what they've been doing in the space. Have you seen their acquisitions there?
Yeah. I mean, 2 amazing acquisitions in New Zealand, and great to see the Serato deal happen. It's amazing.
I was I emailed Andrew saying, hey, you should definitely acquire Letterboxd. And he was like, oh, we're already talking to them.
Oh, wow.
Because I'm friends with
Yeah.
Carl, and I was like, in my opinion, like Carl is probably top 5 entrepreneurs in the country, in my naive opinion, just because he's so understated but so genius.
Phenomenal. Yeah.
And kind of didn't really even get much press from locally, especially from the whole Letterboxd deal. They actually got more press from the Serato kind of association locally than when theirs went through.
I presume that's by design. I mean, that's not really their style they want to build, and it's very, very, very pure and beautiful in that sense. And they're just one of many great examples of the rise of the ecosystem. And I mean, Carl, one reason is because he built wealth and experience and capability, and then he said, hey, I'm inclined to share some of that with aspirational young entrepreneurs. And the question was, well, how many Carls were there for Carl like 10 years prior? And fewer.
Very few. Yeah, I imagine. Yeah. I mean, they had a different benefit, but they had no one to stand on the shoulders of, right? But they had this really interesting time where not very few people knew how to build.
Yeah.
And they were like able to build a lot of cool stuff and, leverage the cost of building back then to then build kind of drastic wealth in a sense, right?
That's right.
Kind of that cash flow piece. I kind of get a feel for early people that are dabbling in venture. They can sometimes get disenfranchised quite quickly. And I get a sense that there's a lack of strategy because it's so illiquid. You can make 3 investments and then all of a sudden you don't really know if they're going to work. It kind of feels like, that's, who knows? And on a day-to-day basis, I know that, from one day we can be on top of the world thinking that, it's just inevitable, to the next day feeling like, oh, this is really hard. What's your kind of view on I guess being a little bit more strategic and patient perhaps in your venture journey? I think you need to make at least 20 before you can even really rate, like even evaluate if you're doing a good job in a sense.
Yeah, it's a different journey than almost every other asset class, right? And part of it is because you get such elation at the beginning. You're like, this is so cool, and it is going to the moon,
Yeah.
right? And this company is going to work, and everything the founders told me just gives me more conviction, right? To the reality that actually is quite hard, right? And if it's not hard, I mean, then there's probably not a real opportunity.
Yeah.
And 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 so then that's like, the next 3 years where you just sort of go in the trough of despair and and have to soldier through that. And the worst thing you can do is just stop making new investments as a result of that, right?
Yeah.
It's statistically, at least within, our 350 companies, the bad news arrives before the good news.
Yeah.
Why is that? Because it takes a long time to build a valuable company, and it takes a lot less time to not work, right? It takes a lot longer than you think to not work, right? Like the average time of the companies that have not succeeded in our portfolio is like 6 years from start to finish. So I think I state that because there's this sort of misconception that, it's just a complete bloodbath and everything fails, and entrepreneurs are just like going, it's just like go to the table, put down all your chips, and you lose. And you're like, it's over. And it's like, that's not how it works, right? Actually, it takes a long time to sort of build, to learn. And entrepreneurs are very resilient and tenacious. And most investors are relatively supportive, right? Most of those companies have raised 4 rounds of capital. Well, that was the average.
Right.
So it's so yeah, patience is the easiest conclusion, right? And resilience. And then, remembering the things that you can control and the things that you can't, right? And guess what? You can't pick winners, like just guarantee it. So, and frankly, if you're an investor and you're an individual, and you're not running the company, you actually can't control the outcome either.
No.
You can help, maybe.
You can add some value.
You can make a connection, right? And, share some resources. I think importantly, you can literally just tell the entrepreneur, like, hey, you're doing a good job. Don't freak out, right? Back yourself.
Yeah.
Because like 99% of people just want to sound smart and sort of ask a pointed question.
Yeah.
or they're literally just searching for dopamine, and founders are their dopamine source. And it's like, tell me something good so I feel good,
Right.
And so then you could become quite dismayed if you reach that conclusion, which is like, wow, okay, I can't pick winners. And I can't influence outcomes.
Yeah.
And it's like, well, actually, you just need to get through that and then say, well, what are the things I can control? And it's like, yeah, I can control the types of companies that are willing to talk to me. I can control the terms upon which I'm willing to invest. I can control how much I invest relative to how much I have. I can control whether or not I give more money to a company, or find a new company, and on it goes. And in that sense, you reach a state of a lot of comfort, because you're like, well, actually, here's some pretty clear things that I can follow and put myself in the best possible position to happen upon a company that becomes really consequential.
Yeah. Yeah, that's a good approach. I think that it's something that's definitely needs to be heard,
Yeah.
because it's a long journey. And there's this book I love called Thinking in Bets by Annie Duke.
Okay.
You should just get all of the new investors to always read this. And it's a professional poker player, but now she advises hedge funds and VC funds mainly. And it's basically disassociating outcomes from decisions. So, with all the information I had at the time and the growth I knew of this company and the founder, etc., I made this decision. And even as a founder, right? Like, okay, I had this information at this time. I put the company in this direction, and the outcome was not what I wanted. But given all the information I had, am I happy with the decision I made?
Yeah.
And I think that's quite helpful, probably for investors, but also definitely for founders, because you get so tied up in the identity of your company.
Yeah.
But you don't control 100% of the outcome.
Yeah. And that's probably to, your 2 points were like patience and, build a portfolio. And the problem is, if you invest in 3 or 4 companies, you can learn nothing because you don't have a statistically relevant data set.
Yeah.
Right. And the worst is, also the best is like, you just get lucky and then you project that onto all future things, and you probably go through a decade of despair where you're like, oh, actually,
Yeah, you invest in one, have a grow like 50x return, and then you invest in six and you lose all your money.
you don't have a return.
Now I have to let the statistics work in my work.
Yeah, yeah,
So
yeah.
20 feels like a good number because I think 10 you're still it's still close. I know that you should maybe get a winner in 10, but you don't definitely not guaranteed a winner in 10. So I think 20 is like
I mean, there's no upper limit, right? And like, so in 2017, I raised a fund that was called IV100 and stood for 100 companies. And it was like one of the hardest funds to raise, right? Like the whole BS around like diversification and like spray and pray and so on, right? So fast forward, and this is visible on our investor portal if you're an investor, but uh, on the portal you can see benchmarks, how you compare to 3,000 investors, right? Some investors are late stage, some are early stage, some are active, some are passive. Some only invest young founders, some only invest in second-time entrepreneurs. Some are funds only, some are direct only, some are both, right? And then there's all the different permutations. Like we're the only relevant data set, I would say. And
is there any way that it's interesting?
well, so this is the one. So here's this fund. Everybody said IV100, like it's crazy, right? There's a friend of mine who was CFO of one of our companies. He invested, 20 grand, which is also my point on like the upper limit, right? Because yeah, like if you go back to when I started and it was 60 grand average per person, per company, per round, and then some investor shows up and says you should do 10 companies, you're like 600 plus follow on million. I don't have $1 million, so I can't do it. So I'm gonna put 50 grand in this one company and just pray,
Right.
and so despite all the arguments, here's this 20 grand investor investing from, that fund invested over sort of 3.5 year period. It's in the top decile for IRR and multiple
Right.
relative to every other strategy in the book, right? And so what does that say?
And that
Right.
person invested $200 essentially.
Per company?
Per company.
Well, yeah, it wasn't evenly distributed.
Yeah.
Which is another really important point in venture, right? Like I don't see it as trying to make a single correct decision. I see it as making a series of decisions based on more information and more time and successive capital raises.
Right.
And in the most extreme example in, Icehouse Ventures right now, there's sort of two where we went from, approximately 100K invested in Halter and 100K invested in Crimson to 35 million ish invested in each of those. Right. And so over years, based on milestones, based on execution, and with a story of being able to, deliver, grow again and grow further and have, more growth ahead,
Yeah.
we continue to invest. Now, would we have been in a position to invest in those companies, either relationship wise or with shares or with information? Had we not been in the first round? Definitely not. So,
Yeah. Right.
I would not think of venture as just a single investment. And the IV100, that I sort of just called it like the Stephen Tyndall fund because it invested in, a very broad array of companies. And then if they came back and based on certain sort of metrics, the fund would invest again and again and again, such that you would end up with some companies having 0.2% of the fund and some having 8%.
Yeah.
And yeah, it's like you would think that then I would say that's like the only way, but actually, I mean, more I'm more convicted that like the positive force of entrepreneurship is so real that it doesn't matter what sort of ego you have to create some sort of fund of some sort of permutation, they all sort of can work, right?
Yeah. Yeah. And you guys are kind of branching out a bit by doing almost JVs right now.
Yeah, I mean, the most pronounced sort of partnership is with Outset Ventures, and it's the home of Rocket Lab, it's the home of LanzaTech, a home of Mint Innovation, home of almost every meaningful deep tech company that's come out of this country. It's the only purpose-built deep tech space of its kind. They have things that you really can only access if you're getting your PhD at the University of Auckland or something,
Right.
at Auckland, or if you work for, I don't know, Fisher and Paykel Healthcare.
Yeah.
Um, and they have this, the like the kingmakers of Peter Beck and Sean Simpson strolling around, right? And in 2019, they'd formed this incredible community, and they had all these assets. And my pitch to them was like, you should really convert some of that into a fund, right? And you have things that we could never build or buy, and we have some infrastructure that we could really help with you having, the scale that we have. And so that was the idea. And it's a wonderful partnership where we can help them, and then as a result, we can be exposed to some really, really great deep tech companies
And have their help in terms of DD and working out where it's at,
Yeah.
rather than having to hire analysts that have that special.
Yeah, the technical parts of the IC discussions I bow out of because I've got no value to add, right? And there's some big brains in that room.
Yeah, that's awesome.
Yeah.
So in the world of entrepreneurship that's being kind of, I think, like you say, it's being kind of shunted forward, I would say, even more so, with the ability for kind of small, kind of scrappy teams to basically build really big companies. Like, what does the average entrepreneur need to do to kind of get on your radar?
Well, I guess there's sort of what do they need to do, and then what do they need to do to be on our radar.
What do they need to do in the end? Yes, I think that's cool. I like that.
Well, first just back yourself, right? And try to be a sponge to all the information you can ingest about your company, your mission, and how to build a company, and learn from people that are like in your shoes or slightly ahead, right? I don't think you're going to advance your company by watching Jensen Huang on like some podcast, right? Like, because he's operating in a different realm at this point. It's inspirational as heck.
Yeah.
But if I had
Inspirational, not operational.
Yeah, it's sort of like we went to one presentation, and the founder is just complete legend. And one of the sort of opening things is, I really think of our company as 7 startups right now. And I'm like, well, that sounds like a really healthy thing, but how the heck is that helpful for me? Like, I just have one company, and I'm trying to figure out how to just raise a seed round, or like, what should a board be, or how do I deal with like dynamics with like a co-founder, like the real on the ground problems. And so the beautiful thing about the ecosystem in New Zealand is how accessible other entrepreneurs are to each other, right? And even the heroes will make time. It's probably their favorite pastime, right? Is spending time helping the next gen. And so, number one, just learn from other people that are in your ecosystem. And it's amazing how much you can accelerate your own success as a result of that. Right. And then I would just aim very high in terms of the type of people that you associate with, the the type of money that you raise. But don't be stubbornly sort of precious, like at the expense of progress. Right. If I was trying to take like a lived example, I got like a lot of sort of like criticism of like, oh, don't take a meeting for less than 50 grand, right, for your fundraise, and only like bring value adding investors into your funds. And I thought, well, okay, there's a spectrum, right? There's dumb money, which is like people that are objectively going to make your life harder, right? They don't understand risk. They're not comfortable in the space. They're doing it for some sort of like ego or identity, or they have some other agenda, right? And then there's like smart money, which is like, I'm a deep tech company. I've got to have Peter back. Very healthy aspiration.
Right.
But somewhere in between is like just high quality humans, and you can raise a ton from people that, in fact, you can raise in most cases way more than if you're just trying to target the icons.
Yeah.
And so, in my case, like I went to the extreme. Like we just opened the, Komodo basically to anybody that was positively disposed to venture and had a little bit of money to invest in. And that's only served us well, right? Like there's no, like, there's this perception that, oh, you must be like overrun with, I don't know, like, nuisance nuisance, sort of like people that have all these dumb questions, and it's just not true. Like you can, there are a lot of just like good humans out there, and if they can advance your cause more rapidly, then you should bring them on board.
Yeah. Awesome. Well, thank you so much for taking the time. I really appreciated it.
Yeah, that's good.
And yeah, thank you.
Yeah, I appreciate it.